Okay, so I'd like to talk about today. What I'm going to present to you is, excuse me, a high reward, low risk option trading using the option butterfly. So a little background on myself. I've been actively trading for over 30 years and was previously executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and ran their international trading desk for over 10 years. So it was a really great learning experience for me, being in the oil side of things, but we did diversify out in all the other markets, and so we were trading all the different derivative markets, from all the S&P futures to the bond futures, to eventually got pretty big into the foreign exchange markets. And then we were one of the first groups to also start trading options over the counter, started doing that back in the mid-'80s. On crude oil. So it was my introduction to options, and have been very passionate about options ever since. Then I opened up an over-the-counter crude oil options brokerage desk for a company called PVM Oil London. They're the largest privately owned oil brokerage company in the world. So another really great learning experience for me there, learning so much more about options. I thought I knew quite a bit, but that was a real eye-opener. So, trading, I tell my members and clients, it's really a kind of a journey of learning. So appreciate everybody being here today, and hopefully you'll learn some things from me. But I constantly learn something each and every day. So that's the thing that makes trading not only a great kind of profession or way to make passive income or a full income, but it's also kind of great for keeping your mind fresh and challenged. So it's a really great business. But the other thing too to keep in mind is that at times it can be very stressful as well, which I'm sure everybody here can attest to. So that's the thing that I love about the strategy I'm going to be talking about today, the butterfly. So the following webinar here is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So let's take a look at some of the best ways to profit from options. And one of my favorite structures is the butterfly. So I've learned and I've taught a lot of different trading strategies over the years, but when I was thinking about what would be the most valuable go-to trading strategy that could help literally every single trader out there, the more than anything else, I knew it was going to be the option butterfly spread. Now, it's got a huge advantage, the butterfly does, because of its unique framework. So what it can do, it can allow you to be more consistent and give you greater returns due to its simple but very dynamic structure. And because it requires only a small amount of your hard-earned trading capital, your trading stress is going to be really, really low. And that's the other thing I love about it. You can get into these types of trade setups for very low Caplet risk. Now, unlike other option strategies such as iron condors, credit spreads, or debit spreads, the butterflies are very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade butterflies, and you're going to be covered for both your offense and defense, so your goals and your protections. So you can make these structures go for you anywhere where you want. You can take advantage of it for income, or you can use these for hedging, which is a great way to utilize it. So the butterfly can also work no matter what the markets are doing. You can be in an up market, down market, or sideways market. They can help to provide you income from stocks that are literally going nowhere. Really helps to eliminate the stress of trying to pick a direction of a stock or the overall market. Really helps to eliminate that time decay expense that many of us are going to have when we're buying long options, and we're going to get that option decay. And it really helps to take the unsettling guesswork out of your trading in a lot of different trading environments. Now, they can also be structured for very, very low Caplet risk. So you can get returns of 10 to 1 or higher reward to risk. Those are very common for the balanced butterfly structure, which we'll show you here today. 1 second here. Now, the butterflies also are very flexible, as you're going to see here. And once you learn the fundamental setup, you're going to be ready to adapt the butterfly for your goals and for your market insights. The other great thing is the butterflies, you can be, structure the butterflies, they can be a delta neutral strategy. So you can take advantage of the markets, just kind of churning, going nowhere, and have the dynamics of the butterfly give you that advantage, which we'll talk about here in a bit. The other beauty is that they can be directional, and that's where I really love to use the butterfly, is in a directional type of setting. So they can offer you a bullish or bearish exposure to the market, when you feel real sure a stock is headed in one way or the other. But if you're wrong, the butterfly is going to really help you to manage your risk, and then help you to maintain potentially large returns. And that's really a win-win situation, for any trader. So that's a great advantage as well. But let's be real about it. The butterfly spread is not going to give you that unlimited profit potential, but they're usually going to cost you a lot less, which you'll see, than buying outright options or stock in general. And they're going to offer you an amazing positive risk-reward trade setup, which is really fantastic. Now, this means that the butterfly can significantly increase the probability of your winning trades, while also at the same time reducing your risk. And that's really what it comes down to in trading. You want to be really aware of your risk and try to really contain your risk and control your risk. The great thing about the butterfly, they can be that hedging strategy that maybe you're missing in your trading portfolio. So it can be used for hedging when you mess things up, and that's going to happen. And it can be, a directional butterfly. We can apply that to a core position, and it's a great way to cover your what pronto when that position starts to move against you. So that's the thing that I found most intriguing about the butterfly, was the hedging component or aspect that it can offer you. Now, by constructing a butterfly around a strike that is under pressure from a core position that you may have put on, could be like a credit spread that's starting to go against you, or a debit spread going against you, it becomes a great way to immediately control, neutralize that risk, and that's going to help you to lower your trading stress. So when we do a trade setup, at Power Cycle Trading, before you even put the trade on, you need to have a trade plan of what you're going to do in case that trade goes against you. And that way, it's going to reduce your trading stress, because you have a plan of action. So we always have a plan of action, and the general plan of action is, okay, let's hedge, and we're going to hedge using a butterfly type strategy. Now, if you use a butterfly, you can use it to help you to keep that original position open. So by implementing a butterfly hedge around your original position, this strategy will take advantage of that time decay element that you're going to see from the butterfly while you wait the trade out. So many times you're going to see that you can put a trade on and it looks perfect, it's going in your direction to start out with, and then the next day it stalls, and you're like, uh-oh, you're wondering if that stall means it's going to correct on you. So you get really kind of concerned about it, stressed out, and you may end up stopping yourself out, and then all of a sudden you'll see it comes right back in the direction that you originally thought it was going to go, and would have been a successful winning trade. So a lot of times all you need is just that little bit more time to let that original position stabilize and then move back in favor. And then at that point, if you've got the butterfly hedge on, you can remove the hedge, sticking with your original trade, and writing it up for what it's worth. So that's the thing that I've found that's so fantastic, even if you don't use the butterfly for an income or speculative type of way to make money. It's the perfect hedging mechanism for your option trading. So here's an example. If you look here, this is a risk profile of kind of a typical debit spread. So if you look here, this is you're long a call here, short a call here. So you've got a call debit spread. So in this particular example, your risk is $300, which is your debit paid. Now that's great. You go into that trade knowing that your maximum risk is that $300 of debit paid, but we never want to lose that at-risk capital. So one way that you can protect this if the trade starts to falter or wobble on you is, the first thing I'll look at doing is, can I convert that to a butterfly to neutralize that risk and reduce that risk? So one way to do that is the butterfly hedge. So in this example, I could look to sell a bear call credit spread with the same series, option series, same width, and in this situation bring in $200 credit. Okay, So what have I done? I just took that 300 at risk, I put a credit spread to it, received 200, now my risk is only $100. So that's a lot better than risking 300, and I still have the potential to make a great return on capital or, leg out of the trade. So basically what happens is now I've got this butterfly risk profile structure. So long a call debit spread here, short a call bear call credit spread here. My risk is now only $100. I still have a nice profit window in here. So if it was to go out at my middle short strike of the body, I can make a huge return on my capital. Or I've got some other options. I could leg out of the debit spread side, or I could leg out of the call spread side, or I could add these various spreads to it to make what we call ratio spreads. So it's kind of like trading. It's kind of like a puzzle. So it's a great way to defend once you understand the fundamental foundation of the butterfly. So let's take a look at the construction of a butterfly trade so you can get a little bit better insight on how it can really be beneficial to your option trading. Now here's an example of the famous company XYZ. And so XYZ here is trading at $45. And we think that based on your directional trading system or whatever you're using, you think that the XYZ is going to go down to $43. Not a huge move, but it's going to go down to 43, and you targeted that based on Fibonacci or maybe unusual option activity. So you want to set up a trade to have XYZ go from 45 to 43, but you want it very low risk. So one of the great strategies would be then to do it as a butterfly. So if you look at this example, we'd be buying, in this case, the 42 call, and so you'd pay $2.38. Now that's remember one option contract's equivalent to 100 shares, so that'd be $238 debit. And then we're going to sell the 43 call, we're going to get $1.67. So if you look at that, that's basically a call debit spread. Now then the second part of this, and this is all done as a spread, but here I'm breaking it down for you, would be to sell another $43 call, bring it in $1.67, and then buy the $44 call above it, and that costs $1.06 or 106. So if you look at this, you've got the body of the spread here is where you're short two contracts of that 43 at $1.67, so times 2, and then you're long, we call these the wings. You're long the wing at 238, the 42 call, and long the wing here at 44. So that's where the butterfly gets its name. So this would be what we would call a long call butterflies because we're long the wings, short the body. So your net debit or the cost or the risk of the trade would be then taking the 238 debit here of the 42 call plus the $1.06 debit of the 44 minus less your credit you brought in 2 times at $1.67 times 100 to convert it to an option spread or option contract. So in this example, your at risk is only $10 per spread, so very, very low. So going in on this trade, wow, if everything really went against you, the maximum you'd lose is $10, and this is very typical of a balanced butterfly. You can get these types of setups. Now your profit then comes down to, if we look here at the profit, you take your middle strike here, which would be the 43 call, less your lower strike, the 42 call. So that gives you $1. So that'd be $1 width or $100 per spread, width of the spread. Now minus the cost of your trade, 10 cents or $10. So your theoretical potential profit's 90 cents. Multiply that by 100. So your theoretical profit is $90, and your at risk is 10. So if this was to go out exactly at 43 at expiration, right at your target price of 43, then you're going to make 90 cents, $90 per option contract or spread, and your risk here is $10. So that's a 900% theoretical return, or 9 to 1. So basically we're looking at not ever usually hitting that 100%, but if you can get 30% of that, 40, 50, 60% on low risk, it's a really good risk-reward trade setup. So that's the beauty of it. Plus, it's a great way to hedge as well. Now, the core concepts that make the butterfly amazing, let's take a look at that next. So the most important option factor for profit generation using the butterfly strategy or options in general really will come down to understanding that concept of time, theta, and pricing, and the effects that they have on the price of the option. So let's do a review of these core concepts to show you how they affect price. So if we look here at an option, the main concept or the main component for option pricing comes down to time value, which is also referred to as the extrinsic value of the option. So it's the premium that a rational investor is willing to pay over its current exercise value, the intrinsic value, based on its potential to increase in value before expiring. And this probability is always going to be greater than zero, thus an option is always going to be worth more than its current exercise value. And the change in the value of the option based on time decay, we can actually measure that theoretically using the Greek theta. So that's the other great thing about options. You have these Greeks which can help you measure what the price of the option will be if certain things happen. It's a theoretical measurements, but they really do help you as far as planning your trade. So what theta does, it tells you how much an option price will go down over time. And that's what is referred to as the rate of time decay of your option, that your underlying option that you're using. And this time decay occurs because that extrinsic value or that time value of the option diminishes or goes down as expiration draws near. So you can also think of it in a simple way as like if you have a coupon that you got at a store. So let's say you bought a carton of eggs and they gave you a coupon for something else, and you'll look at that coupon and you'll see, well, it has to be redeemed by so and so date or else it's not going to be valid, you can't use it. And that's exactly how an option is. You've got a certain time till expiration, and if you don't have that option being utilized and profitable for you, it's going to eventually go to zero. So the characteristics of theta is really helpful. So option theta values are going to be either positive or negative. So if you're long a stock option, such as if you're long a call or if you're long a put, those are going to have negative theta values, and that's going to indicate that they are going to lose value each and every day as expiration draws near. So if the underlying security that you have the option on doesn't go anywhere and you're long a call or you're long a put, that's going to lose value every day. Now the opposite though is the short stock option, and it's going to have a positive theta value. So if you're short the call or short a put, that's actually going to be beneficial to you if the price was to go nowhere or sideways. So this indicates that the position is going to gain value as expiration draws near. And that's the component, that's what we take advantage of using the butterfly kind of strategy, is that time decay element and also implied volatility component, which you're going to see next. So let's take a look then at how you value an option, and this will give you a good idea of the components that affect price and then how we can take advantage of those once we understand that they do affect price. So basically the price of an option comes down to the major component is time value times the implied volatility times the underlying value, which is the intrinsic extrinsic value. And once you know these variables, then you're going to be ready to price your option, know what its option premium should be, and then have an idea of what kind of option strategy you should take or do as far as the current market situation you might be traded in. So here's a table, and I can show you how the effects of price come about here. So if we look here on weekly options now, all the options or securities have weekly options, which is really great in order to utilize and take advantage of. So on a Thursday, you get a new option series, and on that day, when we get this next Thursday, that option will have 100% time component, will be 100% that first day. So if you take that time value times the implied volatility of the option times the underlying value, the intrinsic extrinsic, and we'll keep that at a constant of 1 in this example so you can see how it affects your premium, then that gives you the price of the option. So on day 1 of a new series, we have 100% time, put the implied volatility here at 300, kept that at 1, so your option price would be $300. Now if you come down to Monday, you can see that now that time value is cut in half, and it's only worth half that value, is only have half that time component value. And even if you increase the implied volatility in this example to 800, you can see that your premium only goes to 400. Or let's say you had your implied volatility was only 300, you can see that your option premium would be 0.50 times 300 would be 150. So you can see how time value and implied volatility start affecting your price. And the other big takeaway is that you're going to see that time value goes to 0 at expiration, implied volatility goes to 0 at expiration, and that's what we can take advantage of for the butterfly, both time value and implied volatility. Now the next step is to choose the best butterfly strategy for your trading goals. And one major goal, in my opinion, for every trader is that you should look to select trades that are based on what's going to provide you the most consistent positive returns that have low defined risk and not always the greatest return. And one of the best ways to achieve this is by being aware of the different option butterfly strategies that are available, understanding how they work, and then selecting the one that's going to be best suited for the market environment you're trading and your specific trading goals. So everybody here today will have a different capital account. Sarah might have 10,000 and John might have 100,000. So it's going to make a big difference on the type of risk you want to take. Or you might be able to trade during the morning and not during the afternoon, or maybe just come in once a day. So you need to take those points into consideration as far as what kind of profile of the trader you're going to be as far as your risk. So the butterfly, though, gives you a lot of different variables or structures. So with the butterfly strategy, you've got the long call or put butterfly. You've got what we call the broken wing or skip strike butterfly, and you can use calls or puts. We've got what I've kind of termed the ninja ratio butterfly, which is a really unique dynamic structure, which we'll look at. Directional butterfly, iron butterfly, and then a great benefit is the hedging part of it, hedging defenses using the butterfly. So a lot of different variations of the butterfly strategies that you can use for your trading or to use for your hedging to complement your trading portfolio. So let's take a look and do a trade review so you can kind of get an idea of these structures and how they can benefit the various type of trade setups that you're maybe looking at. So if we look here, the first one we'll look at is a directional option butterfly trade setup on Apple. Sorry about that. So we'll look at here is a directional trade setup on Apple. And so this is going to be a butterfly. Let me pull this chart. So for me, everything really kind of starts with direction first, and then I'll look at what kind of strategy would I want to look at. So in this example, you can see Apple had a big, huge sell-off, and we were looking for it went from that high here at about 156, really got hit hard all the way down here to a little over 142, and then started to stabilize here. So then we started getting buy signals based on our trading model, and we started getting momentum here starting to go above 0, which shows positive momentum, and that gives us direction. Trend line break in here, moving averages starting to break. So everything was looking good for a potential upside move. So we wanted to look to see what kind of target, and the next step I look at is where could it go. So I look at my targets based on Fibonacci. So here would be a target here, target 2, target 3, target 4, price target. Now at the 618 retracement, that's a huge fib level, and so we were looking at this as the actual target for this trade. Plus there was really great unusual option activity at this strike price, so that's the $150 target. So this was a really great target based on this Fibonacci level plus really high unusual option activity. So that was the target we picked. Then the next thing to do is, okay, how are we going to trade to that? So the butterfly was a great setup because it's a very low risk, but could give us a really big payoff if we got to or anywhere close to that target. So the structure was this. So this was actually what we call a skip strike butterfly, because sometimes you're going to see that the options series or strikes are not going to be totally balanced. So you might have in this example, we had the 148 calls 150, but we didn't have a 152. So it went from a 150, so the next strike up was 152.5. So this is what we call skip strike. So it was a skip strike of just 50 cents, which was not too big, but it affects the risk part of the trade a little bit. So if you look at this trade, then we were looking for, it was trading at 145, and our target was to go to 150. So that was based on that Fibonacci level plus unusual option activity. Now we set this up, and basically if you look at this, we did a 148, 150 vertical call debit spread, and then sold the 150, bought the 152.5 bear call credit spread. Had to skip the strike 50 cents. So your trade cost on this was super low, 19 cents, $19 per spread. That's what that cost. Now your risk is 69 to the upside, and that's because you skipped that strike. So if you took 50 cents or $50 plus your cost of 19, that's where you come in with $69. So your total risk, if Apple was just to keep going straight up, would be 69, but your downside risk, if it went down, was only $19. So it gives you a really good risk reward either way you go. So your spread width then was $200. Okay, so 150 minus 148. The cost of the trade to put it on initially was just $19. So your theoretical potential profit is 181 per option spread. That would be a 262% return theoretically if it, on that 69 maximum at risk, so 2.6 to 1. Now, your risk, though, on the downside risk is over 800%. So if you took that 181 over your downside risk of $19, you can see that's a huge return. And so 10 days later, this trade actually went out right close to that 150, which gave it $157 per spread. So let's take a look at the risk profile on this trade. So if you take a look here, you'll see that Apple was trading at expiration right almost to the penny at 150. So it was going out at 149.99. The last part of the day, the last 30 minutes of the day. So you can see here, here's your risk profile top. This is what we call the tent. You can see that purple line is right at the top. It's right there at almost 150 to the penny. So this went from a 19-cent debit or $19 debit to a $176 debit. Okay, so that's 157 per option spread. Now your return on your capital max at risk of 69 was 227. The maximum risk to the downside was $19 to the downside, 69 to the upside. So that was 826. So this spread, so your risk here to the downside was $19. Your risk to the upside was 69. So that's how you get your return. So it was a fantastic structure and worked out really nice. Now here's what we call kind of the ninja butterfly. This is a ratio butterfly, and this is another example on Apple on the call side. So Apple was, trading, looking to reverse to the downside. So we were looking for a downside target for Apple, and again we had really great unusual option activity at the 160 strike right in here, and also Fibonacci levels of support. So again we set up a structure for a target to $160 into expiration for Apple. So here's the ratio butterfly, basically what it is, and this was using calls in order to give this a directional move or bias to the downside. So the basic structure then is, in this situation, is we're long a call debit spread. So you're long the 157.5, short the 160, so that's a long call debit spread. But then the difference is we're going to be short 2 bear call credit spreads. So we're going to sell the 160, buy the 162.5 2 times. So it's 2 to 1 ratio. So you're, in this situation, more short more than you're long, but by having that long call debit spread in it really helps you to reduce your risk. So that's why it's a ratio butterfly. So we can use calls for a downside move, puts for an upside move to structure these types of trades. So the trade setup, we were looking for this going into expiration to hit our target, and the cost on the trade was $15. There was huge unusual option activity at the 160 strike, so that really gave us a good idea where it would probably head into monthly expiration. So the downside risk was 15, the upside risk was 265, but since all that unusual option activity and seeing that kind of happens over and over and over with Apple, felt very comfortable with it. So the trade setup then was to do a ratio butterfly. So you can see here then we were buying that 157 call down here, selling the 160, and then selling the 160, buying the 162 two times. So it's 1 by 3 by 2. All right, so this trade setup then was set up with the maximum cost going in was 15 cents or $15. Your theoretical potential maximum profit per spread was $235. So on your at risk to the downside, that was a 1,566% return. On your risk to the upside, it was an 89% return. So the advantage of this type strategy is you get positive theta decay, so time decay is going in your favor, and volatility collapse. That's another huge component, and a very high return on capital. So on expiration on the 15th, this spread made 176 per spread, and so that was 1,100% return on your downside risk and 66% return on your upside risk. So here's the risk profile and what it looked like. So again, this was almost very, very close to that target price that we had established of 160. So it was going out here at 159.93. You can see that purple line right there, almost the top of this profit tent. So all the time decay, theta decay is all stripped out, the implied volatility, there's nothing left. So it went from a 15-cent debit to 191-cent debit. So that's $15, went to 191. That's 176 per spread. So one spread, you make 176 before commission, and in this situation on 4 spreads, that was $700 on a very low at risk, and a really great structure to take advantage of time decay and implied volatility. So if you look at what makes this up, first it's the components of this ratio butterfly was 1, the actual butterfly itself. So you can see here when this was set up, the actual butterfly cost of this was 70 cents debit, and it went at expiration, that was priced, that was going out at 175. So that was the part of that spread. And then the other part of the spread is the bear call credit spread here, and that was put on at 55 cents. So these are all, when you put this together, this is what creates the ratio butterfly. So that went out with $53. You added all that together, those components, and you get this ratio butterfly, and that went out at $228. So that's the beauty of it. You had the butterfly itself, if you just had that on, made 175. If you made this a call ratio by selling the credit spread, you got that additional profit of 53. So you ended up with over $200 profit per spread on that type structure. Now here's one more example, because this shows you how dynamic this structure is when you look at the effect that theta decay and implied volatility collapse has on this structure. So here's another example on a directional trade. This was on CRM to the upside, and then in this situation was doing a put ratio butterfly for an upside target. Now we were looking just for a move to $80, not a very big move. So it had gone from 80, collapsed down here, and we were looking for this target back to 80. And at the time when it was set up, it was trading right here at 78. So just a $2 move up in a very short duration. So to do this target, we did this as a put ratio butterfly targeting $80. So you're going to see how this the dynamics work, because on Thursday you're going to see that it made 1 profit, and on Friday at the same price at 80, it had 3 times more profit in it, and that's based on the structure of implied volatility collapse and theta decay going to 0. So here in this one we use puts to structure for an upside move. So if you look here, you can see that the initial structure is the 81.80 put debit spread, so that's a bearish part of the structure. And then we sold 2 bull put credit spreads. You sell the 80 by the 79. So the bullish side is 2 bull put credit spreads by 1 bearish debit spread. The combination of that is what creates that ratio butterfly. Or you could look at it as just a put butterfly adding an additional bull put credit spread to it. So it's again like puzzles, once you understand the foundation. So if you look here, the credit this is a dollar wide spread too, which made it very, very low risk. So 81 minus 80 is a dollar wide spread, so $100. Now this brought in a credit of 52 cents or $52. So that puts the difference, your risk. So the risk on this trade, if everything blew up, was $48 per spread. The potential profit was 152 theoretical. Okay, so if you take, it's a 81 minus 79, $200 minus your risk 48, that gives you potential 152. Your max risk would be Caplet Risk, and return on your risk would be 316. Now here's where you get the big advantage. You see the positive theta decay, volatility crush. So on Thursday we took partial profit of $44 per spread. On the risk of 48, that's 91%. But one day later, this was making 136 or 283% return. So 3 to 1. I mean, 3 times more. And that is because you're going to see the implied volatility crush and theta decay. So here you can see the profit tent right here. It's right here. But see all that space there? That's on Thursday. That's still time value that's left in implied volatility. So you're not getting your maximum profit. So on this day, though, took partial profit 44 on your risk of 48, 91% return. So from 52-cent credit, bought back 8 cents. Okay. Now, one day later, though, you're going to see the big impact that implied volatility crush and theta decay has. So here, one day later on Friday, you can see that's up here at the top. All that time value and theta has been stripped out, and now still trading right around $80. It went from a 52-cent credit to an 84 debit, so totally flipped. So that's 136 per spread on your risk of 48, and that's a 283% return. So that's the dynamic aspects of this. You get that implied volatility going to 0, time decay going to 0. So just one day later, this gave you 3 times more return than one day before at about the same price because of that dynamic structure. So there's just a lot of different ways that you can use and utilize the butterfly. So if you'd like to learn more about how to master this high reward, low risk strategy, I've got a really great program for you, and it's just $97 for everybody here today. I like to keep the spaces low because you're going to get some additional bonuses. So here's the link. Let me type that in. I don't know why it's doing. So just use this link here, and I'll show you what you'll get. So you can click on that link. So you're going to get my on-demand course. This is a course that I did. It's been recorded, and it's a 5+ hour course, 100% on the option butterfly. So you'll get it broken down in 30-minute modules, so it's easy for you to go back and forth, and view. It'll be on the cloud, so you can access it from anywhere. Plus, you'll get the PowerPoint to the course and some other bonuses. My courses are very detailed, so this course is $97. If you go to my website, powercycletrading.com, and you don't buy it today, you can buy it, but it's $297 on my website. So if you sign up today, you'll get this full course, 5-hour plus course, recorded on-demand course on the butterfly, all the different unique structures, and you'll get one follow-up. We're going to do a follow-up Q&A, which will also be recorded, so that's an additional bonus. You'll get my option strategy manifesto, which I'll talk about here. I'll show you what that is. Power tool guide, which you'll see what that is, and if you've never been a member to my trading club, you'll get one free trial month to that. So great package, total of 688 value for just $97 a day. So on-demand recording, 30-minute modules. It's a 281-page training course, the PowerPoint, and again, my courses are very detailed. Now, so use that link there, powercycletrading.com/PRO. And you're going to see in this course, this is basically what's covered in the course. You're going to get the core basics of what many traders just don't understand about the butterfly, what makes it so great, what Greeks are vital and how to use those Greeks. So we go through that. It's not very complicated. I keep it fairly simplistic. And then here we get into the butterfly. So we cover how, why, and when to use the long call or put butterfly, a broken wing butterfly, the ninja ratio butterfly, another combination of broken wing ratio butterfly, directional butterfly, iron butterfly, and a vacation butterfly. So a lot of different variations of this structure and how to take advantage of them. And then what are the best times? Do you put this on 2-5 days ahead or 2-3 weeks out? So time frames to capitalize and utilize the butterfly. And how do you get that structure where you do get a 10-to-1 or higher? So with as little as $10 down per spread. So we'll go through these structures on that. And then the big part of it is how do you take advantage and capitalize on option volatility collapse, theta decay. So that's a big part of it. So you come away from the course understanding exactly how to take advantage of volatility and time decay. And then a really fun part too is how do you get these big profits, low risk profits going into an expiration. So a good chunk of the course focuses on how to play what we call pinning trades when option expiration, take advantage of an expiration. And then how do you target the correct option pinning price or strike for it to expire? And for that, we go through technical analysis using Fibonacci to show you how to get those fib levels, and then how to look for the pinning strike based on option unusual option activity at the very strike. So we go through that part of it. And then you get the step-by-step checklist of how to put the butterfly on, take it off, execution of management, and the biggest part, if you get nothing else out of this, is to understand how to hedge using the butterfly for a core position or a vertical debit spread or bull put credit spread. So a very, very extensive course. And here's one little nice feedback. Said I've been doing the Ninja Fly, and they're the most incredible way to put an option position on. I've made huge gains in the SPX trades. Thank you very much for teaching me this strategy, Debbie. So you're going to get the total blueprint option butterfly course, 5+ hours, 281-page training manual, live follow-up Q&A, which will be recorded. You'll get this printout for your desktop of my favorite option strategies, the profile, what they are. You'll also get my Greek power tool guide. You can print this out so it tells you, hey, what is theta, gamma, delta, so you can put that on. And then you're going to get a trial membership, 1 free month to my trading club, Power Cycle Trading Club. And with this, we have a virtual chat trading room open each day. I'm in for the first hour, back for the close. Daily market video updates, nightly video updates of any seasonal trades. We have a live Q&A every week, which is also recorded. Traders Vault for education, monthly reward points, $20 per credit for every month you're a paid member, and discounts on everything that I have on my website, courses and trading software. So really extensive package. Hopefully you'll take advantage of it here today. And it's just $97. If you miss out, you can come back later and get it $297. So just use that link below, www.powercycletrading.com/pro. There you go. I think that's it. Make sure that works. Oh no, that's wrong. Darn it. Hold on. Okay, this should work, I hope. Yeah. All right. Yeah, use that and it'll give you the payment link there. Yeah, so the course goes into, what you're going to pay, what the expected move is, what's the fair value of your option. It's a very, very detailed course. So it's a very, very great option course, period. You'll be quite happy with the course.